If you only talk to your CPA or March and April, the fact is you have a tax filing service and you really don't have a tax strategy. But today we're going to turn that on its head and show you the way to powerful tax savings.
I'm John Malone. This is Greg O'Brien. We are the co-CEOs of Anomaly CPA, the #1 tax strategist in the United States. And like Greg said, we're here to talk to you today about some big client wins we've had recently and just our overall process and how we approach tax strategy.
Yeah, awesome, John. So I think the easiest way to talk about this is talk about a real client story that we've had recently. So we onboard between 7 and 10 business owners per month that are typically high growth, typically in the digital world. So I want to give a good example of what we saw and what we did and the results behind that. So today we're going to talk about this digital security company that was pretty high growth, weren't they?
Yeah, no doubt. And I think digital security is one of those business or one of those verticals that we're seeing a lot more opportunity in various areas of the tax code. So why don't we start there? What were some of the main things that jumped out at you when you took the first deep dive into this?
Well, for context, right, this client came to us from a CFO partner that had been working with them. And he said, hey, they're pretty frustrated with their current CPA. They're very interested in learning more about strategy and planning, but they're just not getting any advice, right? And we hear that all the time from incoming prospects. They'll say, hey, we read something you wrote or we read something online. Do you think we qualify for this or that? My current CPA says don't bother with those kind of things, right? That frustrates us, doesn't it really? You see that all the time.
Yeah, no doubt. And I think a lot of it comes down to communication, right? So, throughout the year, they're not communicating, they're not bringing things up to, or their CPA is not really welcoming some of the ideas, welcoming some of the things that kind of takes them out of this like compliance related hamster wheel. So we really try to look for those things, really try to be proactive about those things. And this is this is really a good case study showing those things that we look for and identify.
So this company, Digital Security, they work with a variety of different industries on their side of things, but few owners involved here. And they're set up as an S corporation, which was initially a good thing to see here. But a few things immediately stood out to us. Number one, they were missing some pretty key deductions. And these aren't easy deductions necessarily. They're things that have some nuance to them. So we pointed that out right away as our kind of diagnosis, or we say our tax autopsy started. So we circled these. The second thing our brain went to as we're looking through our roadmap is, wow, where are all the tax credits, right? Because digital security, there's a lot of good tax credits they could be getting. We didn't see any of that. And the last thing that we kind of noticed here is, hey, they're making more and more money, but why do the owners have this feeling of like they're broke, right? They felt like they were scraping by. They didn't have a big savings for retirement. It just didn't seem right to them. So as we started this process, we kind of had a feeling, oh boy, this is going to be a big one.
Yeah. So let's break those three sections down. So the first thing we kind of dove into was really like the entity, how they were operating the entity. And in this case, it was an S Corp. So what were the things that you saw with this particular business, digital security company, S Corp, that they were doing wrong that we could rectify?
Yeah. So the first thing we saw now, these are equal owners, right? So they're 33 and a third owners each. Ideally, probably not the best thing to have more than two people in an S corporation, but unwinding that can
Why
also.
is that?
The reason of that is S corps or S corporations have what's called disproportionate distribution rules, meaning dollar in, dollar out, subject to your ownership. So if John and I were partners in an S corp and it was 51-49, if $100 comes out, it has to be split 51-49. It's a very rigid structure as compared to a partnership where you can do what's called special allocation. So when you have a lot of people involved in an S corporation, we see this a lot. All of a sudden they're like, uh-oh, Mike needs to take more money, but Mike's only a 2% owner. He can't take more money. He has to go through wages. So multi-member S corps are not ideal, but in this specific situation, it was not worth kind of unwinding that, given they've been operating for about maybe 10 to 12 years now.
Yeah. So basically, really what we see a lot is you have multi-member S corps and people are taking money out willy-nilly, and that's going to completely violate their S election, which could lead to a lot more problems. But in this case, it's really, they weren't doing so much of that. It was more about optimizing how they were utilizing the S corp. So what do we look for in that instance?
Yeah. So the first thing I like to look at is just, hey, what's the ratio of their wage distributions? And in this case, pretty surprised early on to see pretty much every dollar coming out of the company was being run as a wage. So I believe they were taking about $700,000-$800,000 of profit between the three of them. All of that was coming out as a wage. Now, when we initially just said, hey, guys, why is this coming out as a wage? The answer we got was, that's how we've always done it, and our current CPA didn't say anything about it, right? Now, here's the thing. It's not wrong. There's nothing wrong with doing that. It sort of just defeats the purpose of being what's called a small business corporation, right? S corps were developed by the government to help small business owners. And a lot of the quote unquote game of an S corp is balancing the ratio of the wage a shareholder gets paid as compared to their distribution. Why is that? Well, on the distribution portion, you're not subject to FICA and Medicare taxes, where on the wage portion, you are. So if you're taking everything out as a wage, there's not a real great point of being an S corp. So we need to look at what's called reasonable compensation. So the first thing we did was what's called a reasonable compensation study and said, hey, do they really need to be zeroing out their profit through wages every year, or can we take some of this money as a distribution?
Yeah, yeah, it's so key because if they are just waging out all their income, like Greg said, there's really no reason to be an S corp. You might as well just be, a full-time employee and not get the benefit of really being a business owner. So what are the like apart from just the FICA component, right? You're paying the FICA tax on just the wages. The distributions aren't subject to FICA. What are there any other benefits in kind of optimizing that wage?
Absolutely. So the big thing here was okay, we figured that out. We need to change the wage around, right? That's unfortunately not a retroactive thing. So this was probably late 2025, I believe we took them on. So we said, all right, in 2026, we're going to set your wage at a different number, right? And we showed them the savings, which is each double digits for each of them, right? They each probably saved 10 to 12K by making this pretty easy maneuver and flipping some of their cash out of the business to a distribution versus a wage. So that was the first thing. Now, the second thing is like, okay, how do we set this at the appropriate level? The other thing we noticed is these guys actually owned another business that we were not dealing with. It was a kind of a more passive venture, and each of them had that spouses that worked as well. So they were all considered, high income, I would say, when you look at their total tax situation. There's something called QBI. Now, there's two things we noticed with QBI. Now, QBI is what came under the 2017 Tax Cuts and Jobs Act. It gave small business owners, which small businesses pretty large, right? 25 million or below, pass throughs. So either Schedule C or partnership or an S corp. It gave them what's called a haircut off the top, right? A 20% deduction on their income. However, when you cross certain income thresholds, there's different what we call phase out limits to this. So the first thing we notice as they're doing our kind of our tax autopsy was, hold on, they are above these income limits. They do have wages paid. They do have income, but each of them had $0 of QBI deduction. Uh-oh, red flag, right?
Right.
That's something we would notice right away.
Yeah, no, no. And I think that the beauty of this is you're really just tweaking like just an operational component of the business and realizing huge tax savings, right? We're not like moving heaven and earth. They don't have to really invest further money. It's really just, hey guys, like we need to make one small change and like the fruit of it is huge.
Absolutely. So we had to figure this out. Why are they not getting this QBI deduction? Now, in fact, we've actually seen people where their tax preparer was maybe not that keen and the software just didn't pick it up properly and they just missed it, right? In this case, it was not. In fact, their accountant had actually classified them incorrectly from the beginning. Now, digital security can mean a lot of things, but what these guys are actually doing, they developed and were using AI and different kind of SaaS products to service their customers. And there was a very heavy technology software component to what they were doing. So we did what's called a QBI study in our world. And we said, hey, why are they being put in this services bucket, this SSTB bucket, as we say, which gave them no deduction? And it was very, very clear from us reading the regulation and kind of interpreting those to this particular situation. They absolutely qualify for this deduction. And it was just improperly classified probably by the two accountants ago back in 2018, and it never got picked up, never got fixed. Now, how bad was this mistake? Pretty bad. So we were able to go back through the statute of limitations a few years, and each of them, right, is going to get, I believe, $25,000 to $30,000 of refund checks coming to them. So we're talking, excuse me, about $75,000 between the three of them in actual cash coming back.
Yeah, that's amazing. And I think like all those things, it just illustrates like what the difference is between, you know, us who really focus on strategy and planning versus just, another firm that's just kind of doing a lot of compliance work. And there's nothing wrong with that. But like Greg just went through, we're analyzing a wage, making sure that the wage to distribution allocation is optimized. We're maximizing QBI, then we're doing this SSTB study. So like we're doing a ton of stuff and it's really like it's driving huge savings.
And here's the cool thing, right? This is not rocket science. Yeah, we're pretty smart what we do, but it takes planning, it takes care and attention. Why does this stuff happen, right? Why did that happen? Well, they came from a firm and there's probably really smart and talented CPAs there, but they were focused on volume tax filing, right? How many S corps can we get done in 1 year? That's not what we're going to do. That's not what we do. We want to focus on the relationship and spend time to figure these things out because it just takes care and attention to understand this. But as we moved on in this engagement, the next thing we found, right? We're not done yet. So the next thing we looked at, again, on the S Corp side, is that, okay, again, they're high income. They're over what's called the SALT limit, right? Not necessarily Morton salt you put on your table, but I'm talking about state and local taxation. So in the past, right, if you had over $10,000 of state and local taxes, you could not deduct that on your federal tax return. Now, 2026 and forward, right there, 25 and forward, I should say, the law changed. Now it's $40,000 after the latest tax cuts. But as we're looking at this, we said, okay, they have high income. They have a lot of state taxes. These guys lived in higher tax states, right? Just think East Coast, we'll say that much. East Coast states, so higher taxes. What's the next thing we would look for, John, in that kind of situation?
PTE. So what we're looking for here is just to figure out, hey, how can we not lose money with that salt cap, right? They live in high income states, so they're going to get maxed out by that salt cap pretty quick. And this is a very successful business. So what we're doing is we're just figuring out, hey, what is their allocable state tax that they need to pay at this business level. We can make an election at the state level to pay that tax at the business level, and then they basically get a flow through deduction. I'm not going to go like deep into the weeds like you would, but
Yep.
that's really what happens, and it's a huge win for them.
So again, something to pay attention to, right? So the John PT, what's called pass-through entity tax regime, all you're doing, right? I tell people, right pocket to left pocket, you're going to pay the same amount of taxes anyways. Why not make that personal expense a business expense legally through these PT elections? I think like 36 states now that allow for this. Again, there are some cases where you would not want to do this, right? And we're not going to get into that. But for most business owners, it's something to really examine and look at, especially if you're in a high tax state, especially if you have leakage over that salt cap. So again, these guys had never even heard of it. They said, salt, what's salt and what is PTE, right? So again, not necessarily their accountant did wrong. I'm not saying that, right? They just didn't bring this opportunity up to them. And this is, again, not something where they have to invest $1 million. It's, hey, we need to go to this website, we need to elect into this program, and we need to change how we're doing things, right? So this, again, was, I don't know exactly the amount, but it was over, probably over 5 figures each in tax savings they were going to get over a multi-year period. So again, something just wasn't being paid attention to.
Again, just operational thing. Check the box. I mean, there is work that needs to be done. Like, don't get us wrong. It's not something that just simply, you just check a box and it's done. But I say that because operationally, it's not. We're not moving mountains to get these things done. So I think like when someone comes in with an S corp, right? These are the things that we're gonna hit. We're gonna hit, all this optimization stuff. Make sure the wage is optimized. Make sure QBI is optimized, make sure that they're classified appropriately, make sure that they're taking advantage of PTE. So those are just routine things that we're going to be doing as a matter of course. And like, like in this instance illustrates, like it could be huge wins just by doing that. So
Absolutely.
so now like now we're kind of looking industry, what industry they're in. They're in security, but they're in tech. They're doing a lot of innovative stuff. So that kind of triggers research and development tax credit. So that's something that we would always take a look at. So just walk us through what we did in terms of the analysis and what we found in this instance.
Yeah, so Section 41, the R&D credit, a lot of noise around that last couple of years because the government had stopped the deduction for it. Now it's back. So the credit and the deduction are different things, but it all plays together. Now, we come from a background, right, the R&D world in tax, and we said, okay, they've developed a lot of their own proprietary AI. They've developed some of their own software. This is probably a case in which we should look at an R&D study. So the first thing we did there is that, okay, we need to figure out, should we even spend this investment of time going down this road? So we do what's called a pre-qualification. We sent a little questionnaire to them. We sampled some of their customer contracts. We sampled some of their methodology and some of their project records. Just a quick sample to say, okay, we're in business, we're not in business. And based on our sample, we said, yeah, there is absolutely qualifying research and development here. Now, we'll do a whole other episode on R&D, but essentially it's a 4-part test the government makes you pass. And here's the key. We often hear from people, well, I'm not developing software. I'm not a scientist. I don't qualify for that. Wrong. R&D could be something like a restaurant could have R&D by changing how the drive-through system works, right? It's not just science technology. You have to use one of the sciences, but one of those sciences is computer technology. So R&D was huge for them. And actually, this is a pretty complicated process. This is still in process with them, but we're talking over a 3-year period from a credit perspective, which flows back to them, probably close to 6 figures here of missed credits. And the nice thing is, though, you can go back and amend this. We are doing multi-year amendments to go back and get these credits. And then proactively in the future, they should still have more credits going forward. So we're like, wow, another thing we found here that just, again, was overlooked in the past.
Yeah, and it doesn't have to be this like wildly brand new product, right? It just needs to be new to the business.
New to the business, right? So there was always a common misconception when I started learning about R&D years ago is that, oh yeah, well, I'm sure someone else has already thought of this idea, or someone else has already probably made a similar algorithm. Doesn't matter, right? The government's looking for you to incentivize you to innovate within your business, not necessarily saying, hey, you need to be Elon Musk and innovate for the
Right.
whole world. It's innovating within your business. So this credit, right, that came about here was another aha moment for us. Said, okay, between the wage thing we mentioned at the beginning, the QBI issue we mentioned, the PT, and this, we're talking significant tax savings, like money they're going to get back in their pockets that they can either invest back into their business and hire people, or maybe they put it back in their business and they actually pay themselves, right? Because they haven't been able to feel like they're making a lot of money in a while because of so much was getting eaten up by taxes. So that is really fulfilling to us as tax planners.
Yeah. And I think that's like the big thing that we always educate on too is, with tax savings, we want to show like the compounding investment value of those. So it might just be reinvesting in the business. It might be, like Greg said, at the personal level, then you can invest, in other areas and then just kind of keep that wheel going, right? Saving tax, really doing things in a prudent way, and then just kind of compounding, your wealth in doing that.
All right, and the last thing we'll say we found, this one's probably a little bit more boring, but it's important mentioning. So this client came in, right? We had a CFO they're working with, but we actually took on their bookkeeping as well. So as our bookkeeping team got involved and our accounting team was looking at things, they noticed an issue on the balance sheet, right? So there's an issue on the balance sheet, specifically within the assets, where something should have previously been written off for tax purposes and was not. It was kind of hung up on the balance sheet. And I think someone made a bad journal entry back in the day. But again, we were able to now fix this and actually take that expense and fix that prior issue that happened. Because if you don't have good, accurate bookkeeping, there are probably issues out there. And what we always say internally is, if you want to find where the bodies are buried in a business, look at the balance sheet. In this case, just a lack of attention, right? A business owner doesn't actually know all the nuance to a balance sheet, and their tax preparer was not reviewing that balance sheet in detail and didn't notice that there was a difference on the balance sheet for the tax versus the books, and this issue arose over time.
Yeah. And that's another point that like illustrates, the difference between like tax strategy and like what we do versus just mere tax compliance is, I think, in a former solution, right? May not be right or wrong, but that tax preparer is just getting that balance sheet at the end of the year. They're just preparing a tax return, then see you next year, right? That's the process, that's the workflow, that's what they're getting paid to do. We're kind of starting there and doing investigation on all the financial statements, right? Where can we make efficiencies? Maybe just from like a business operations perspective, but more
So important.
importantly, from like, can we save money? Like, is there strategies to employ here, right? I mean, that is what's ultimately getting produced in the tax return. So it's always our starting point. And here, fortunately, there was a big win.
Yeah. Well, this is really a great example here. And let's just talk about how we think about the world here at Anomaly. And I'll give a little bit of a background and John can jump in here. So we've been using the same methods actually for years, going back about 7.5 years now. And when we started the business at Anomaly, we noticed, hey, why is no one doing planning? Why is no one really spending the time on this? And the answer we continued to get in the market was, well, my CPA doesn't have time for that, right? And I understand that because I worked at firms over the years where I saw they didn't have time for it. They had piles of paper over their heads to file tax returns, and I said, that's not going to be us. So we fortunately started with good habits. So what we have developed over time is a process where when a client comes in, they are going through a deep dive, right? We call it research and development. We're going through and researching their situation, their businesses, their real estate portfolio, their family situation, and we're coming back and saying, hey, here are the 5 to 7 levers you should be pulling, and here's how we're going to do it with you. So not only are we just telling you the ideas, the biggest thing for us is full service implementation. We need to help you implement those ideas because we've seen time and time again people that are told to do something and they don't know how to execute it, and that leads to problems, right? So we want to come in develop the strategy with you, and then implement the strategy. So that's kind of the first piece of what we do. At the same time, John alluded to this. I can't stress how important is getting your numbers in order, because if you don't have good numbers, how would you expect someone to plan for your taxes, right? So the other side of our team, typically at the same time, is working to correct errors on the accounting and or set it up for the first time so we can get a good system. Whereas you as a business owner can say, okay, it is the end of the month. I know exactly how much money I made, and I know exactly how much I need to reserve for taxes, versus just saying, I have some money in my bank account. I think I made money. And you wouldn't believe how many people operate that way. So our team's doing the onboarding on the tax side, finding those strategies, the accounting team's fixing the items, getting things in good place. And then we move into the implementation phase, get our T's crossed, our I's dotted, and then we're off to the races.
Yeah, yeah. And I would just say, so like within the first 30 to 45 days, like that is what we're doing. We want to set that foundation. So we have like a launch pad of exactly where we're going to start from. And I think it's all about like, let's get all the puzzle pieces together. Let's get everything fit where it's supposed to fit. So like on the bookkeeping side, business, tax strategy, personal, like everything is kind of together. And then really kind of identifying, hey, what are the things that we're going to focus on in the short term?
Yeah.
And then what are the things that are maybe a bit more long term, right? Because we want to look at the full picture, which is part of the puzzle. It's not just mitigating tax now. It might be, exit planning in the future. We want to keep everything in that lens. So we try to get hyper focused on what are we going to do in the short term and what are we going to do in the long term. So when we get to implementation right after that, like 30 to 45 days, that is where we set the course of, hey, we're going to be your execution partner. We're going to get these things done for you. Or if they need outside external partners, we have our platform of people that we work with to get those things done and be your liaison to get those things done with you. So I think, as Greg alluded to at the beginning, kind of going through our process, that is what I think makes us special, not just the being the number one tax strategist in coming up with the ideas, but executing them for you, making sure that they're on the tracks, and getting everything off on the right foot. So that is like the first month and a half of working with us. That's what it will look like, and then we kind of move into our ongoing process, which is equally as important because tax strategy and tax planning takes effort year in, year out.
Yeah, for sure. So we've developed a system where throughout the year, there's contact and relationship being built between our tax strategy team and the end client, and also our bookkeeping team and the client, right? It's one cohesive unit. If you have a lot of separated services, or you don't have anyone managing situations throughout the year, you're going to end up in a situation where there's a lot of ideas and there's no action. So we have a system where our team is working with you throughout the year, keeping your numbers straight, but also keeping your tax strategy safe. And of course, dealing with the tax filings, tax compliance. But the stressing point of this video is if you're just going to your accountant after year end, or maybe calling them in a panic in December 31st, that's not tax planning, that's not tax strategy. In fact, there's very little you're going to do on the actual filing of a tax return that's going to save you money. There are some things, but not a ton. We always say the tax return is simply a report card, right? How well did you plan throughout the year? If you're not happy with the result of your tax return, maybe it's because you didn't plan correctly throughout the year. So we're trying to turn that around. But the big thing to realize is you really need to have solid numbers throughout the year that are going to lead to lower taxes and lead to a system which you can have confidence and clarity that tax planning is being done correctly.
Yeah. Yeah. And like, how do we do that? I think the biggest thing is communication, right? We need to encourage communication. Everything that we scope out in our solutions are all, fix free. What you see is what you get, right? You're not going to get billed for extra calls, extra time. We want to encourage that type of stuff. Because if someone's like in a traditional model, if someone's like scared to ask a question because they're going to get a bill, they're not going to ask the question. So we want to make sure that that script is completely flipped. So we encourage that communication. It's unlimited, and then we have pre-scheduled meetings throughout the year, and those are really just to keep our clients accountable, make sure everything's on the tracks. We're delivering, projections, estimated payments, those sorts of things. But more importantly, it's keeping that tax strategy on the tracks, showing them the difference of like, hey, this is what we're doing, and this is what the baseline scenario would have been. And I think it's big to just see the fruit of that, at least 2 times per year and even more.
For sure. So whether you're working with someone like us or another CPA or tax strategist, it's really important to understand, hey, what is our rhythm throughout the year? How are we going to continuously plan? Because all those cool things I mentioned in this digital security client, the fact is the laws could change soon. the fact is their situation could change. They could go up, they could go down. You got to be ready to pivot. So when something changes, there should be someone there that you have accountability with that can quickly pivot the plan. What if they get an offer tomorrow to sell? You know what? These guys actually already have a strategy to sell their business because we've already gone over that with them, right? We have a tax strategy if they sell their business. If you haven't thought about the exit planning yet, might be in trouble, right? So make sure whoever you're working with, you're having these conversations with. Now, if you do want to work with us here at Anomaly, we do work with those business owners that have revenue in the mid seven figures and in your netting somewhere, usually three or $400,000 or more per year. We can probably help you with tax strategy, bookkeeping, accounting, and keeping things on the track. So if you're interested in learning more, plenty of ways to contact. There's links in our bio. But we'll come back with more stories, and hopefully this one was enlightening for you.
Yeah, and I'll just add to that too. I think the people that we work the best with, apart from just kind of like those metrics that Greg outlined, it's the mindset, right? Like
Yeah.
this digital security group, like they wanted to better their situation.
Mm-hmm.
They were willing to really receive the education and then move forward with us, right? We're gonna do a lot for you, but that mindset, that forward thinking, growth oriented mindset that wants to better their tax situation, that's where we can have huge wins together.
Amazing. Well, that's it for now. Take care.
Thank you.